Welcome to the Dental Team Podcast. I'm your host, Kiera Dent, and I have this crazy idea that maybe I could combine a doctor and a team member's perspective because let's face it, dentistry can be a challenging profession with those two perspectives. I've been a dental assistant, treatment coordinator, scheduler, biller, office manager, regional manager, practice owner, and I have a team of traveling consultants where we have traveled to over 165 different offices coaching teams. Yep, we don't just understand you, we are you. Our mission is to positively impact the world of dental, and I believe that this podcast is the greatest way I can help elevate teams, grow VIP experiences, reduce stress, and create A-teams. Welcome to the Dental Team Podcast. Hello, Dental Team listeners. This is Kiera, and you guys back because I like him and you like him. We're bringing back Paul Moore. He's been on here several times to talk about investing and real estate. You guys have heard him so many times. So Paul, welcome back. How are you today?
Hey, great, Kiera. How are you doing?
I'm doing really well, thanks. Paul is one of my first podcasts that we're actually doing over Zoom with cameras on. And it's kind of unique to see you in person. Normally we're just, chatting to a blank wall. And today we're actually talking. So it's fun to see you. Thank you for taking time. You're out in Virginia.
Absolutely.
Is that correct?
Yeah, I'm in Central Virginia.
Awesome. And Paul, for those of you who haven't heard you, remind them exactly, I know you've done a lot, kind of just give them your brief background bio so that way the listeners can know you again.
Yeah, I worked at Ford Motor Company for a while. Then I sold, then I bought started a company, sold it to a publicly traded firm about 5 years later when I was 33. Started investing in real estate, flipped a lot of houses, flipped waterfront lots, started a couple online marketing businesses, did a subdivision. And I was always trying to figure out how to get involved in commercial real estate, but had no idea where the on-ramps were. Finally built a multifamily property, which is apartments, and operated that for years, and then ended up writing a book on multifamily, and then expanded into self-storage and mobile home parks. I've got a new book coming out on self-storage investing sometime later this year.
That's awesome, Paul. So I was curious when you were saying that, is investing in self-storage right now with the pandemic and everywhere we are, is that something you're still recommending? Has that kind of been put on pause? Where does that sit with investments?
Surprisingly, we don't want to make light, and we don't want to ever say we're taking advantage of someone's a misfortune. But the 4Ds drive self-storage investing. The 4Ds are downsizing, dislocation, death, and divorce. And unfortunately, there's a lot of pressure out there on people, and all four of these are happening. And you've got the additional situation, not only are people downsizing, but there are businesses downsizing. So people, they might close their restaurant, but they want to reopen later, or they might close their office space to downsize. They need a place to store all that stuff. And so self-storage, and then college students who are uncertain of their future, self-storage is booming.
Yeah.
That really is.
Okay, let's talk about this because this is not what we had planned to talk about. And I'm looking you in the eye, so I have to just honestly express this. Because self-storage, how do you get into self-storage? I'm going to go back to this. I know we've talked about it on other podcasts, but I was super curious because I was thinking a lot of people I know through COVID, whether it's due to choice or placed upon you, are downsizing. I know I even thought about it. I thought, do we really need to have headquarters anymore? And then I thought, what am I going to do with all the stuff in that building? So therefore, natural response was putting it in storage because I didn't want to sell it off. I didn't want to have to rebuy it because you're probably going to reopen. So if that's something, because do you go buy a self-storage place? Do you make your own? Because this is something also, let's talk about real quickly. The reason I'm even bringing this up is because we were talking about taxes coming up and that you can defer, or you can, we're always looking for ways to move money when you're in the business of we don't want to pay it to taxes if we don't have to. So what do you do with self-storage? And also let's talk about taxes if you're open to that. Because as soon as you said self-storage, I thought, gosh, another one that's a consistent revenue stream. That's I feel like it's one that people don't think of often. Yeah.
So this may not be what your listeners want to hear, but I'm going to tell the truth. Investing in self-storage seems like a passive investment, like investing in land and waiting for a developer to come in and buy it. It's really not. Okay, so the worst self-storage facilities out there, in other words, the ones we want to buy, are those that are passively managed, those that are basically somebody sets it and forgets it, and they just hope that, if we build it, they will come. It doesn't work that way. If you really want to maximize your investment, you're going to need to actually have a really good system. You're going to need to have marketing. You're going to need to have people pushing, upgrades, things like that. And so we don't recommend people passively invest. Now, if you want to invest with a group and have a manager running it, that's great. If you want to passively invest with an operator who has great experience, that's great. If you really want to do this on your own, you should be focused. If you're busy as a dentist or a hygienist or whatever you're doing, you probably shouldn't do this on the side unless you've got somebody really hyper focused on it. Does that answer the question?
It does. And it's because it requires more work than you would think it would. And so therefore you're going to be stuck in that. So as you said that though, and I mean, we're going to speak candidly here. That's how I roll. How do you know? Because like a group investment, you said that a few times. I know that's what you guys do. I get leery of group investments. Like I listen to Tony Robbins. You read all these financial books. You've got fiduciaries and brokers, and you've got all these people. You've got your financial planners. How do you know which group to invest with? Like what are some good questions to ask an investment group to interview to know if I should invest with them or not?
Kiera, I would never have imagined how hard it is to find the right investment group until I got into it. We determined about 2.5 years ago to start investing heavily with other operators. And so we spend a lot of time doing due diligence. And there is so much involved. It's hard to find a great operator, a really best-in-class operator. So, we actually do criminal checks, background checks. We check their loan, how they do their debt, how aggressive they are or conservative they are. We see how they treat their staff and investors and how they talk about their spouse and how they talk to the flight attendant or the waiter or waitress. We want to see what kind of people they are. And the first thing we want to do really is just get to know what their morals and their character are. We want to see that they've been investing in the same asset class since before the Great Recession. There's all kinds of things like that we want to do. And it's quite lengthy. I mean, today, my business partner is visiting an asset in a different state, just dropping in unexpectedly to just see if it's run as well as the operator says. Next week, I'm flying to Alaska to see an asset. So that's what we do.
Okay. So if I'm looking that was really helpful. I was like, gosh, writing all the notes down. You saw me this time. So if I am looking as a dentist or as a team member to invest, right? We talk about self-storage and you said, invest with a group. What types of questions should I be asking and vetting to make sure I'm really choosing the right group to invest with?
Yeah, I mean, you're going to definitely want to do the criminal check, the background check, the reference check. You're going to want to drop in or maybe even pay somebody. There's actually services out there that will literally drop in.
Sorry, Paul. Where am I going to go? It's like, do I just Google this? Like, truly, I'm thinking about this. Like, do I start Googling?
Find somebody?
How do I find somebody? Then how do I vet them? So like, is it a Google search and you're just like, look for a great investment group? Or is it referrals? I mean, like, how do you find people like yourselves?
You could find some, we're not on there, but you could find some on crowdfunding sites. But those are actually marketed, though. In other words, those sites tend to benefit when their operators get investments. I think a more neutral way to do it would be go to this website. I'll give it to you. There's actually a couple groups. One is called the Real Estate Crowdfunding Review. And I don't remember if there's really a V in front of it, so you might want to just Google that. But Real Estate Crowdfunding Review, Ian Ippolito was a tech investor. He started reviewing these different deals. He had the same questions you did back in 2014, Kiera. And so he set up this website and it became very, very popular. And so people go there to find different operators. And operators like us, fund managers like me, we can't go there. We're not allowed on the site. And so we don't know what they say about us. We just know that people have come to us and others and say, yeah, I saw you on there. Some people say there was, somebody said this complaint, somebody else had this compliment, et cetera, et cetera.
Interesting. Okay. So it's solely for you guys, the operators, the fund managers cannot go there. So it's kind of like rate my professor, right? The professors in college, me as a student, I can rate them and I can have this anonymous rating. So that way other students coming through, if it's a great professor, cool, take them. If not, don't. But the professors can't go on there. They can't see what their ratings are. As far as I know, maybe they can, but I would imagine that that's more what it's like.
Yeah, I had no idea there was such a thing, but it sounds very similar.
Yeah, those are college days. My siblings are still in college, and so she's like, I looked on Rate My Professor, and they have terrible reviews, so I don't want to take that person. I was like, oh, I forgot. Rate My Professor's out there still. Okay, that's super helpful. So I go there. Then we're gonna do like criminal background reference check, do drop-ins, seeing if this investment group, and do all investment groups do like storage and self-storage? I would imagine that's not all. So then how do you find somebody if you're going to self-storage or you're going to real estate, some of these more passive income, or does it really matter what one you invest in? Because that's where I'm like, well, are investments, or should I be looking for a certain type of investment when I'm looking for it? How do I know what I want to do? I know I've got this excess fund. I know I want to build for my retirement. I know I want to not have as many in taxes and finding ways to not defer my taxes, but to, what is it? You know what I'm saying?
Defer your taxes. I think that's right.
So like, how do you even know what you want to invest in?
That's a hard question. I think it's really good to go on a website called biggerpockets.com. And you just ask that question, like say, hey, real estate investors, there's like 1.7 million real estate investors on there, and they answer questions. And you can just say, hey, here's my situation. Here's about how much I'd like to invest this year or in the future. What do you recommend? And you'll get, you might get 5 and you might also get 50 responses, and people will tell you what they recommend. That's a great place to start. It's one of my favorite sites.
Do you have any podcasts, Paul, that you recommend? So I know people obviously listening to the Dental A-Team podcast are podcast junkies. Are there any good podcasts? Because I've looked for investment podcasts and I don't know which one is truth.
Yeah, it's hard, isn't it?
It is.
So, I'm going to promote the same group again. Bigger Pockets has the top real estate podcast that I know of in the world. There may be other ones I don't know of, but the Bigger Pockets podcast, they actually have several other podcasts. Like they have one for newbies. They have one for business, the Bigger Pockets business podcast, but their main podcast has, I don't know, I think it's like 400 episodes now. They do one every week. And highly recommend that. Another one is The Real Estate Guys, and it's also called The Real Estate Guys Radio Show. It's the same podcast. Highly recommend them. They're a little bit more intense, not as much for new investors as people who are really serious. A lot of medical, dental, and other professionals listen to their show.
Cool. That was really helpful. Thanks for letting me totally derail what we had originally planned to talk about. As you were saying those things, I thought, well, I'm in a similar boat to a lot of the people that listen, and this is a zone I don't know. So I'm going to bring on experts and ask them the questions that I also want to know in order to help our listeners truly get the information that they want and that they need. So with that said, Paul, I know pre-show we had chatted about, I'm going to pivot gears. So there you guys go. Biggerpockets.com, Bigger Podcast, Bigger Pockets podcast, and then the Real Estate Guys or the Real Estate Guys Radio. That's more for experienced people. If you're newbies, I'm going to be going to check out Bigger Pockets podcast. I'm a newbie. This is why I bring Paul on, because then I can ask him. That's why it's a little stressful to have you on camera today, Paul, because I'm like, oh gosh, you're seeing me as a real person today, asking my real questions like a little student taking my notes. But that's how I am, guys. That's how it is. So, Paul, with that, let's kind of pivot gears, because you were mentioning some things about the taxes coming up. July 17th, I believe, is the new tax day of 2020. So kind of walk us through the ideas you have for taxes and what you had kind of talked about pre-show.
Yeah, there's so many. So real estate is one of the very best places to avoid and defer taxes. There are so many different ways to do it. Rather than taking a real deep dive, why don't I just tell you a few? One is a 1031 exchange. A lot of people have heard that term. It's even turned into a verb now. People are going to 1031 something. It basically means you're selling one property and you're investing in another, and all the depreciation that you took over the years and all the capital gains from the appreciated value of the property, you don't pay taxes on that. You're kicking the can down the road. And if you do that several times, you can do something called swap till you drop, meaning if you pass away someday with a property that you've never paid tax on, your heirs, unless it's an extremely high amount, there are thresholds. Your heirs will never pay taxes on that. They'll reset the basis at the time of your death. So these 1031 exchanges can be very powerful. A lot of people don't like the 1031 exchange because there's a strict deadline. You've got 45 days after closing to name the new asset you want to acquire. And another problem is there's hands-on management. If you're a full-time dental A-team staffer or dentist, you probably don't want to be managing a big property or a bunch of properties on the side. And so the answer to that one is do a 1031 exchange into a Delaware statutory trust, which is a property that's managed by a third party, and they just generate profits and they send the profits to you. All you have to do is walk to your mailbox. You're deferring your taxes going into it. You're deferring your taxes at the end, coming out of it, and you're deferring taxes while the income is being produced because you're a direct owner. I could dive very deep into those two topics, but that's a couple, and I'll see what questions you have before I go on.
Hello, Dental A Team listeners. I am so excited because we have truly been fortunate and blessed to work with so many incredible practices across the nation and globe. We have what is called our Platinum practice, and that is super popular. And this quarter, we are only bringing in 3 new Platinum practices. This is an area that is going to grow you exponentially. So give us a call. We only have limited space. I said only 3 this quarter due to popularity and demand. So let's get you in as a Platinum practice this quarter. So I do have a question. I feel scared about deferring taxes. I'm somebody who pays my taxes. I'm somebody who does not. I don't like to, like you said, kick the can down the road because I'm always afraid of, okay, Paul, so what's going to happen? And like I think my first year in business, I got kicked in the pants with taxes. And I am so afraid of them that this is not an exaggeration. I have 3 different tax funds. So I always have the one that my CPA is helping me prepare for that's in our main account. Then I have a backup one that every single month I actually put money into a tax savings account. Profit first status. So we have like our 30%. Then I put more money into a separate one. And then I have an even third backup on taxes. Like I said, it was so terrifying my first year of business. And so I think for me, the term of deferring taxes stresses me out because I feel like I prepare for taxes now and I don't like to push my problems down the road. Just like when my car breaks down or if there's some little thing, I fix it right then and there because otherwise I'm just compiling my problems for later. So walk me through why, with knowing that that's my mindset, I think a lot of dentists feel the same way. Why would it convince me it's a good idea to defer taxes in this instance?
So one argument not to defer taxes that I don't think you mentioned is the fact that, or the possibility that taxes will be higher in 20 years or whatever than they are now, that the tax rate will be higher. Now you can do the math on this. If you defer taxes, let's say you buy something for $500,000 and you sell it for $1 million, you're going to have capital gains, which is 15 or 20% plus the state rate, if any, on the gain, on that $500,000. But you're also going to have some depreciation you took along the way. You will have to repay, it's called recapture, the taxes on that. Now, if you defer all that tax, if you don't defer it, let's say you're going to end up with, let's just say $800,000 instead of $1 million when you sell that. Well, if you end up with 800,000, you're going to be able to reinvest that. And then 10 years later, let's say you sell something for 2 million, then you can reinvest only 1.6 million, et cetera, et cetera. You get the idea. But math will show you, and I believe I can prove if we had time, that if you defer the taxes, you kick them down the road, the increased amount you reinvest is going to compound substantially more over time. And if you swap till you drop, that's an easy decision, because if you do that, you will literally never pay the taxes on that. But even if you do pay someday, I believe the improvement, your situation will be way improved. And there's lots of graphs, and it's just simple math. And I really do believe it is better to defer the taxes in almost every case.
Really? Okay. And you're just only deferring on like your real estate properties. Is that correct? Or is it on anything? Or is it just capital gains?
Yeah. So the 1031 exchange only works on real estate as of December 2017. Before that, it worked on art and planes and trucks and boats and cars. But now it's only back to the original intent of the law, which was for real estate only.
Gotcha. Okay. So if you guys are interested in that 1031 exchange, do they talk to like CPAs about this? Do they talk to tax advisors? Is it your CPA should know?
Yeah. Yeah. I mean, I always recommend make sure your CPA is a tax strategist. And if you're doing real estate, make sure your CPA is a real estate tax strategist, because they know things that your typical accountant would never know. And it's really, really powerful.
Do you have any that you recommend? This is me putting you on the spot, or like, because it's always that, oh, well, do I just Google somebody? Again, going back to my Google knows everything for Kiera, apparently. Do you have some good CPA tax strategists for real estate that you recommend?
Yeah. Can I name one or two?
Yeah, of course. Absolutely.
Okay. So what I'd recommend is Warren Tarl, and that's spelled Taryle. Warren Tarl is based in Scottsdale, and he helps people all over the country. He's an amazing CPA. He used to work with a guy who I recommend as well, named Tom Wheelwright. Tom Wheelwright is also in Scottsdale, or Phoenix, and he is an amazing real estate tax strategist as well. So those would be two I'd recommend right off the top of my head.
Awesome. And I know Jonathan Van Horn's a great CPA. I'm not sure if he knows real estate. I know for dentists, like I recommend Jonathan Van Horn. I recommend Scott Haberman out of Colorado. Jim Clark with CPG I think he's in Illinois. Those are fantastic CPAs, but I don't know if they have information on real estate. So thank you for that, Paul, of two people that you know really do, because real estate, you guys know, I don't know why I have this like itch to get into real estate. I might get burned so badly, but that's why I love to talk to you, Paul, because I feel I'm doing my research on the podcast of what to do to prepare for that, because real estate fascinates me. And I think it's a really interesting way to have passive income in some ways. It diversifies your retirement portfolio and it allows you to do it. I mean, there's so many pieces. So with that said, there's the age-old question. We've watched COVID take place. We've seen it. What are your thoughts on investing in real estate right now?
Well, I still am of the opinion from where we sit right now, and I'm in agreement with some of the investors like Ray Dalio, Howard Marks. I can't prove it, but I believe Warren Buffett is thinking the same way, that there's going to be a huge correction ahead, a real problem. This problem's not gone away. It's not going away right now. And the impact of the downturn, the impact of all these jobs lost, up to 42% of people will never go back to their job, they say. The impact of retail and office and malls going south the way they are in the real estate realm. I think there's going to be a huge impact ahead. And so one strategy that I think is pretty fun, I'm going to use some round numbers here. If you can get a home equity line, let's say at 3 or 4% interest rate, let's say 4. Or if you can let's say you have a JP Morgan account that, you have stocks and bonds in, and you can borrow against that account at 2%. So let's just average those. Let's say you can borrow $500,000 from JP Morgan, and let's say you can take $500,000 in home equity line at 4%, your average interest payment is 3%. Okay. Now you've got $1 million you pulled out at 3%. Now here's a strategy you can consider. Take half of that, and this is assuming you believe, like I do, that there are some real problems. We've also, by the way, got record amount of printing of the US dollar. And so that's going to cause potential inflation, potentially bad inflation. And so let's say you took $1 million out through these two loans. You're paying it back at an average of 3%. Now invest half of it in something that has a very steady, stable income. Let's say a statutory trust. That's something my company's doing right now. Investing in a Delaware statutory trust would, you'd be getting a return tax deferred of typically about 6%. So you've taken half the money out, borrowed at 3%, and you're paying it back. You're using half of the money you took out. You're getting 6% on it. That pays the entire interest rate on the money you borrowed. Then you take the other half of the money and you invest it in what I'm going to call an commodity insurance policy. And that would be like investing in silver, gold, or other hard assets that are going to actually go the opposite way of the US dollar. If the US dollar loses value, in theory, these are going to go way up. And it's going to be sort of a hedge against that inflation or hyperinflation. That's just a strategy that we're recommending for people who have real dire concerns about the economy right now.
Interesting. Okay. So with that 6%, this is me again, just asking a sincere question. A lot of times I get leery of investments because I can think I'm getting a 6% return, and they are real sneaky about skewing these reports. So how do I know? And then there's like all the fees that they tack on. So a lot of times I could think I'm getting this huge investment. It's paying for my interest, but the reality is that 6% that I think I'm getting a return on actually isn't there because they've chopped away with all their fees, with all the pieces. I was just watching a financial conference the other day, and they were talking about how if you aren't careful with who you choose, you can think you're saving so much for your future. And then when you get there, like maybe you think it's only 1%, but it's actually 2% with the fees. And then they also take that once you retire. So how do I know, and how do I vet from your experience for these people to invest in to make sure I'm not losing on all those fees? Are there certain things to look for? Is it just doing my research? Is it just being burned? Like, how do I prevent that?
No, you need to read the prospectus or the PPM, and you need to compare. You need to see what fees are being charged. You need to go to somebody who's an objective third party or Google it and see if these fees are reasonable and customary. See if that 6% is net return to the investor or if that's the gross return before fees. And of course, there's no guarantees in almost anything that you're even going to get that amount. So the reason I mentioned a Delaware statutory trust is, unlike other real estate vehicles, it's it's not guaranteed, but it is very close to that. It's very stable. It's a stabilized asset. It's something that has a very, very predictable return. And that's why I mentioned that vehicle, that structure.
Gotcha. That's really helpful because I think I almost get so afraid of investments because I've heard all these horror stories, and you read, and it's like, you should get into investments like at a younger age because the compound interest and different pieces like that. But I also get leery because I feel if you don't invest right, a lot of the things you think you're building are actually being chopped away by all the fees. So that was helpful. So Paul, in a nutshell, I'm going to just go back. We talked about the self-storage and how that is still a really great investment. If you want to do the group investment, how to actually vet for that group investment with the due diligence, the criminal background, looking how aggressive they are, how they treat people, doing a pop-in. And then you mentioned two really great places of the crowdfunding, but you said the realestatecrowdfundingreview.com was a really great resource for anybody looking for that investment. And then the biggerpockets.com or the Bigger Pocket podcast, along with the Real Estate Guys radio, is 2 great resources for people who are wanting to figure out how to invest different pieces like that. Anything you want to add on to that? Because that was like at the beginning of the podcast. I just wanted to recap for everybody wanting.
No, that's awesome. No, I don't think there's anything I'd add to it. Anybody who wants to get into real estate passively or actively, we just covered some of the major places you can go. Of course, there are lots of books out there as well. And, some of them are like if you want to invest in apartments, there's a book called The Complete Guide to Buying and Selling Apartment Buildings by Steve Burgess. Mm-hmm. I recommend that one. I've got a book called The Perfect Investment. That's about apartments.
How do you feel about apartments? Are they good or bad?
They're great. They have wonderful long-term demographics, wonderful risk to reward ratio. I believe in the future of apartments. However, they've been significantly overpriced for some time, Kiera. So
yes,
we have not been recommending apartments for a couple of years. That's why I expanded outside of apartments.
Makes sense to your self-storage and RV, right?
Yes.
Mobile home parks.
Self-storage and mobile home parks, right?
Mm-hmm. Okay. That's helpful. And then you talked about the 1031 exchange. So for the capital gains and how to kind of kick that down and defer the taxes in a way that really you're not going to be paying on. So definitely doing some research and getting that real estate tax strategist CPA. You mentioned 2 really fantastic ones. And then the last thing you shared with us, which was really helpful, was that getting the home equity and like the loan for $1 million, I don't even know what we'd call this, and putting it into the Delaware statutory trust to be able to get a higher net return that's basically paying your interest and then able to invest in the hard assets like silver and gold to be able to hedge against the inflation coming up.
Right.
Awesome. Paul, that was a wrap today. That was a lot of information that you guys is clearly over my head in a lot of ways, but I love, Paul, that you broke it down simply and I have resources and areas that I can go research and find out more. So, Paul, any last things you want to add on or let the listeners know if they're interested in finding out more?
If they want to contact me, they can come to my website, which is wellingscapital.com. That's WELLINGSCAPITAL.com. I also do a Wednesday call. I have people who contact me as a result of these podcasts or blog articles or my book. And I just basically say, look, Wednesday at noon Eastern, which is 9 a.m. Pacific, I do a call most weeks where I answer anybody's specific questions. So if somebody wants to come on that call, they're going to have to wade through listening to other people's questions, but they can I'll try to answer all the questions I can. I also do a show most weekends, either Friday or Saturday, on Bigger Pockets. It's basically called Bigger Pockets Live. And during that show, I answer as many questions as I can as well.
Cool, Paul. I love that. How do they do they go to wellingscapital.com to sign up for your call or your show? Or how do they find that?
They can just put an information request in at Wellings Capital and say that they want to find out when the next show is or the next conference call.
Cool. Well, Paul, you're a wealth of resource and knowledge, and I appreciate you just giving back and answering my questions selfishly. Thank you guys for going along this podcast. These are the questions I want to know the answers to, but I'm so scared and don't know even like who to talk to. So, Paul, thank you. Thanks for your time today. I really appreciate it.
Thanks, Kiera. It's great seeing you again. Take care.
Likewise. All right, you guys. Thanks so much for listening, and we'll catch you next time on the Dental A Team podcast. And you guys, that's a wrap on the Dental A Team. But don't worry, the Dental A Team actually has a newsletter where we send out more tips and tricks every single week straight to your inbox. No, these are not podcast topics. These are additional topics that have downloadable forms. So head on over right now to thedentalateam.com, register for our free newsletter. We don't spam you. We don't send you junk. We just send you tips and tricks for your team. This is a great way, you guys. You could get your whole team on an email campaign if you can't get them to listen to the podcast. So head on over to thedentalateam.com right now and become part of our newsletter family.